Hello, everyone. Here we are sitting with Tai Boutell, Santa Cruz Lending Group. We're here to just chat a little bit about mortgages, what's happening in the real estate market. And, Tai, I'm glad to have you here and exciting stuff.
Thanks for having me.
Yeah,
I think
awesome.
there's a lot of fun things to talk about. So
Totally. And we've had some great ones recently, so I just kind of wanted to
winners.
share with our audience and, talk to clients about what we're doing out there in the market and what options people have. So a little bit, just kind of we can maybe touch base on, we recently had a really cool success story, um, on somebody that we helped. That was, I mean, seemed like it was all came together pretty good and pretty quickly. But uh, maybe you can tell us a little bit about it. But I mean, basically, I think you introduced us to this person on a Monday, and it all was done within a month or two.
Yeah, and it feels like it came together easily. It went smooth and it was quick.
Right.
Um, but there was a lot behind the scenes that made that happen. So
Yeah.
when magic happens and escrows are smooth and easy and close efficiently, it's because there's great teams behind it. And so that's what happened with this particular client. Yeah, I talked to them Monday morning. They didn't think they could do this transaction. They didn't think they could qualify, pull it off. Ran some quick numbers, and I said, "Yeah, you can do it.
Right on.
You can make this move." And then I said, "You need to call Eric." And I think you met with him that day. I think that Monday night you went and saw him,
Right. Yeah. Yeah. It
and
was quick.
it just went from there. And so it was that beginning of that team operation, and then the referrals that you lined him up with to
Yeah.
help him sell his house to prepare for another purchase. All the while we're doing the paperwork for the loan. He has little kids in the house. He has a full-time job, and it just went like clockwork because we were all just hands on deck. So
Yeah, it really was. It worked out great. And this timing, it was of the essence, right? In this business, you got to strike. When things are there.
that's
It's a
right.
great property. It's a one of a kind property they got, and having everybody there to make it happen. And I know they were super stoked to be able to get this loan. That I mean, they got they were below market at the time. I mean, I think rates were somewhere in the sevens at the time, and they got rates in the fives. So it's like things like that. They
Yeah.
were surprised. It helped put the deal together. Our relationships with other realtors in the community helped make this all happen too. And then like you mentioned, our team, right? We had everybody there to basically prep the house,
hmm
get their other
hmm
house ready to sell within days.
They were thrilled.
Yeah,
They
so
were thrilled with those services.
it's
They all
awesome.
worked out really well. And on the loan side of it, we got the loan process. The appraisal was ordered immediately. Just get the
Oh,
ball rolling right out of the gate. Went right in through underwriting, got it approved right out of the gate. And so then we were just ready for the other property to sell and to close. And again, it's the team, and it felt easy and smooth, but there was a million steps behind the scene, and they all just came together so nice.
yeah, totally. So that was a great one that I wanted to share. And some other stuff we didn't, maybe everybody knows it's available out there, but we've got some HELOC products out there. We helped a client with recently, basically pay cash for a property that really couldn't get financing, and so it allowed them to close on a home, and that went really smooth too. I mean,
Yeah, as it goes for second mortgages, there's basically two types: HELOCs and HELoans. HELOCs are adjustable, HELoans are fixed rate. So if you go back a few months or certainly a few years, nobody wanted an ARM, adjustable rate mortgage, right?
right,
Terrifying.
right,
Who would
yeah,
ever do that? Nobody would do that.
sure,
So you do the HELoan. So it's a fixed rate second.
okay,
So it doesn't adjust. It's a 30-year term. You don't have to worry about the rate moving, going up.
interesting,
The problem is a lot of the big lenders are still pitching that product. So if you take that product, you can get the same interest rate as a HELOC, which is a line of credit, which
okay,
is an adjustable rate mortgage. But we all know that on Wednesday, rates are coming down. So if you're sitting there with your HELoan, nice fixed rate, safe product, everybody else's rates come down by a quarter or 0.5% that day, and yours doesn't. So a HELOC is the product. That's a home equity line of credit. It's an adjustable rate mortgage. It's really one of those few times in the cycle of interest rates where we say, hey, interest rates are at the top. They're up there. So go ahead and take it now. It's going to come down over the next couple of years, and that's the HELOC. It's a
that's
great
a good
product.
point. I didn't think about that too, right? So if you lock one of these up now, yeah, I know rates are higher, right? As some of these HELOCs started at like 9% or something, but now
Or
they're going
higher.
to or higher, right? 10, yeah, true.
Yeah.
Short term money, but I think the cool thing is that those rates are something that's going to, as rates adjust and we're seeing a downward trend definitely happening, that those payments and those minimum interest charges are going to come down.
Yeah,
So,
absolutely. And so the second mortgage, whether it's a HELOC or a HELOC, is very popular right now.
yeah.
The secondary market is feeling that there's a big surge of interest for second mortgages. And so the HELOC, everybody wants a HELOC. So get a HELOC. But if somebody starts talking about a fixed rate product on that second, it's probably in many cases not the best product for the situation. But like you said, it's a short term anyway, typically.
Yeah.
I mean, it's a 30-year loan, but let's all hope it doesn't last that long. But over the next couple of years on an ARM, it's coming down. Your rate's coming
It's
down.
going to come down, and they could refinance and in a fixed rate once they get the rate they think they're comfortable with, to pay off that equity line if they don't have some
Refinance
other
anytime.
Yeah,
Yep.
exactly. And
And one of the reasons why that second mortgage is so popular right now is because a lot of people have very low rates on their first mortgage,
okay,
whether it be in the 2s or the 3s or the 4s. I mean, better than today's rates. And so leave that alone and take out a second mortgage, a way to pull the equity out of your property without selling it, right? There's only two ways to get money out of your property.
True.
One is a refi or cash out line of credit, or the other one is to sell it. So if you don't want to sell your property, you got to get the money out somehow. So that's a good program, and you could use that to buy a property, use it for an investment purchase or another primary property, or like we just helped those clients, the property was questionable whether it could get financing, so a line of credit came off of their house, used it for a cash purchase.
Boom.
Win-win.
Worked. It was killer.
Yep.
That's awesome. Another one. We've got so many cool things happening here right now, but it's we've got a property coming up for sale right now that we helped sell a few years back, and turns out that the loan they got is Assumable, which we're getting ready to list this property, and they have a rate in the threes, the low threes, and so we're getting ready to market this property. And tell us a little bit about that. I mean, this is kind of a rare bird, right? We're not going to see this every day, but I think it's a cool story, and it's really out there. And so now somebody's going to maybe look at this property, and they can assume this person's 3 and whatever % rate is out there.
Yeah, that's right. This specific file is an FHA loan.
Okay.
So FHA and VA loans are assumable.
Okay.
So you have to qualify. So somebody who took out an FHA or VA loan 2 or 3 or 4 years ago, they're probably in the low 3s or 4s or 3s. So this client, I think, is in the low 3s. So the buyer, if they qualify for an FHA loan, which has kind of the lowest threshold of qualifying, so most people should qualify for that, can assume that loan and take that interest rate.
Wow.
And off you go. So it's a great way to go. Adjustable rate mortgages tend to be assumable as well, but we see very few of those because anybody who had one 2 years ago, of course, refinanced into a fixed rate loan.
Gotcha.
But for this specific file at FHA, fabulous opportunity to get a low rate right out of the gate.
Yeah, awesome. And I mean, that's just, I think what's really cool is there's so many different things. If people don't engage with you or myself early enough, they can't get a full education on some of this, right? And then when you find that property, all of a sudden you're scrambling to what's the best program. But if they reach out to you or myself, and we can start to educate them a little bit on, what their financial situation is and how can we leverage what you have to make you a better home buyer or, seller and a buyer. I mean, there's so many different scenarios. I mean, we just had one that was somebody used basically their investment funds to leverage, basically pay cash without touching their money, but they didn't want to have that leveraged, or however the right word is. So they got a delayed financing. So, I mean, that's another, there's so many different tools out there, right?
Well, and to your point, you got to start early. You got to start these conversations.
That's right.
So you know how to prepare yourself for a purchase or a future refinance, line of credit, whatever it is.
Yeah.
But if you don't start that conversation and start talking to professionals about how that's going to come together specific to you, you could miss out, or you could get a product that's not best for you. And that the file that you just referenced, that's a pledged asset line of credit against an asset. Use that for the purchase, but that's not a long term. It's a very short term loan from their own asset and pledge against their asset. And now they're doing, within 90 days, they go ahead and do a refinance, take all the cash out, pay back that asset that they had pulled the funds from. And that 90-day rule, that's the acquisition indebtedness, so that they could have that, the tax benefits.
The tax benefits.
The tax treatment of that.
Is that loan treated like as a purchase loan? So it's not like a cash out loan, right? So they get the better rate.
Well, so that the purchase money loan is for tax benefits.
Okay.
But the refinance is a refinance.
It is. Okay. So it's treated like a regular refinance.
Yeah,
Okay.
exactly.
Okay.
But it's the favorable tax treatment that is within that 90 days. And that delayed financing, as you referred to it, is doing that transaction within 6 months,
Okay.
as far as the lender's concerned.
Got it.
But the 90 days that we're working on with this file is for taxes.
I mean, there's so many details out there. And
So
that's
many
why,
details.
people don't talk to us, right? Because there's a scenario where you might not know you even qualify
Right.
for it, could save you thousands and, or get you, there's so many different scenarios. So, for everyone that doesn't know, Ty's office right next door to us here, him and I work, a lot together on many transactions, and we're just a phone call, text, or email away, right? So, reach out to us if you want to know more about what's happening in real estate and maybe all of your lending needs.
And there's a lot of needs for everybody. I
That's
mean, whether it's today or tomorrow or yesterday, and we do need to talk about it because it's changing. It's a very dynamic,
Fluid for sure. So, Ty,
topic.
thanks for sitting down with us today. It's
Thanks
been
for
awesome.
having me.
Yeah, we'll do some more of this.
Sounds good.